Good morning, everyone. We're just waiting for a couple more people to sign on and then we will get started. Hang in there with us. Just one more minute and we're going to get started. Okay. Well, good morning and welcome to this month's virtual CFO Focus. Year-end tax planning update, strengthening your tax position, overall business now and for 2021. For those of you joining us for the first time, my name is Kathleen Alexander and I am a partner with Sachs. Through the CFO Focus seminar series, we strive to bring timely business advice on the issues faced by CFOs and their financial managers. And before we get started, there are a few housekeeping items that we need to review. First, this webinar is being recorded, so there's no need for you to take notes. We will email it to you within 24 hours. Second, if you have any questions, you'll see that there is a question section on your dashboard where you can type in your questions and we will try to answer them throughout the presentation. And finally, if you're here interested in obtaining CPE, you must stay connected through the whole presentation. You must answer 3 of the 4 polling questions, and you must complete the participants course evaluation form that is located in the handout section of the webinar control panel. You need to download the form, complete it, and mail it back to the address on the bottom of the form. So you can do that now, so at least you have the form. And the CPE certificates will be mailed out to you within a week, so you'll have them for your records. So for today, I'd like to introduce our presenters for today's topic. I'm very excited as your moderator today to present to you Shivani Jain, our partner in charge of tax, Steve Ehrenberg, our tax partner, who's a member of our PPP task force. I have Joy Mytak, who's the co-leader of Estates and Trusts. I have Lawrence Gradsky, or as we know, Larry, the partner also in charge of trusts and estates. And then we have Craig Casano, our tax director. So they're going to be presenting our topics today, and our agenda is we're going to talk about post-election tax update, why estate planning before year end 2020 is essential, last minute planning opportunities to consider now, the New Jersey entity level tax, and the Paycheck Protection Program. But before I turn it over to Craig, we're going to start off with our first polling question. So if everybody can get ready. The first Thanksgiving was celebrated in 1621 and lasted how long? 1 night, 3 days, 2 weeks, or a month? So make your selections now if you want to get CPE credit for this event. And we are almost completely caught up. Just a couple more seconds. If you want credit, make sure you take the polling question. If you're having trouble submitting your results, please press escape button on the keyboard, and then you should be able to log in your results. Okay, we have over 80% participation. So let's give you the answer to the question. And it is 3 days. So I know that we're all tired after 1 day of Thanksgiving, eating all that turkey. In the past, when it started, it was 3 days. So thank you for sharing that, for participating in the first polling question. And let's get started with our presentation for today on income tax planning. Craig, off to you.
Thank you, Kathy. I appreciate it. Thanks for the warm welcome on this frigid, cold hump day. Happy Wednesday, everyone, and thank you for joining. Again, I'm Craig Casano. I'm a tax director here at Sachs, and I work primarily in the high net worth individual tax space, working directly with Larry Gradsky and Shabani, as well as the rest of the tax partners and folks within the firm. So very excited to be speaking with you all, and a couple of things that we'll be chatting about today, specifically within the individual tax as well as some business tax item space, is as it relates to potential changes to the overall tax landscape that are on the horizon based on the recent elections. And the one thing that I will say, my one caveat clearly, is that we here at Sachs unfortunately don't have a crystal ball. I personally certainly don't have one. Otherwise, I would definitely be using it to pick the winning lotto numbers and calling Joy and using her to do some savvy estate planning for me. But what we are planning on doing, and what we're going to be targeting to do today, is outlining the potential tax landscape that could be out there based on Biden's proposals and campaign. And even though we are inching closer towards that 12/31 day, which is just a short 5 to 6 weeks away, coupled in with the holiday season, there is time to certainly think about the overall tax plan, and certainly contact your Sachs advisors to start having the conversations to see where there's areas to result in some tax planning, and more importantly, focus on some tax saving opportunities before the calendar flips to 2021. So with that said, another thing that, as it relates to the potential change in tax landscape, is we don't know exactly where we're going to end up, right? We know pretty much where our presidential election is falling out, but we're still up in the air as it relates to the Senate. And over the next few weeks, we will see where we end up, and that will dictate where our tax landscape could end up on a go forward, whether it be 2021 changes or even 2022. That also would still yet to be determined, depending on where things would shake out, when in actuality any potential changes to the law would go into effect. So a lot of things to keep in mind as we roll into this year, based on where we currently stand with the current law and planning opportunities that are there, as well as looking on the horizon to say, here are some of the potential changes that could be, and how should we start doing some reverse planning to think about, maybe these are some areas where we might want to focus as relates to maybe our businesses as well as ourselves personally. So without further ado, let me start off with it. From an individual tax perspective, let's start with our current law from a tax rate perspective. And under the current regime, we have 7 tax brackets ranging from 10% to 37%. 37% beginning to kick in with incomes exceeding 600,000 or so in the married filing joint range. Under the Biden plan, there's a proposal to increase that top rate back to the 39.6% rate that it was prior to TCJA, Tax Cuts and Jobs Act. And ultimately, that would stick with taxpayers earning more than 400,000, where those increases in taxes would come about. And that 400,000 is a key figure to keep in mind throughout our discussions here, as a lot of Biden's proposals tend to be sticking in that 400,000 income range ballpark. Next slide, please. Thank you. So flipping directly from tax rates themselves to capital gains, which is a big one. So currently, under current law, the top capital gain for long-term capital rates, which is the preferential rate, is 20%, coupled with a 3.8% for the net investment income tax, or Obamacare tax, on incomes over 250 for married filing joint. There's also a 0% 0% on capital gains for taxpayers in the 10 and 12% brackets. And as the brackets go from 12% and they start to increase, that's where the top rate kicks up as it hits the top income tax bracket. The other thing under current law, GPs in private investment funds, private equity funds, and hedge funds currently, as they receive carried interest, which in theory is compensation or their profits interest for managing these funds, so to speak. To the extent under the current law, there is long-term rates on that income if a 3-year holding period is met. Under the Biden proposals, just to kind of do the mirror side of the current law and how these and the proposal under Biden to some of the changes under these is that 20% could potentially become 39.6%, or the top ordinary rate for incomes exceeding $1 million. And then there's a presumption that 3.8% net investment income tax will remain, and that an elimination of the carried interest treatment in all aspects, whether it's 3-year holding period or not, would go to an ordinary tax rate and eliminate the preferential 20% treatment. So definitely something to keep in mind for planning purposes that could be out on the horizon there. Next slide, please.
Craig, just a comment on that. If you think about it, your ordinary rates, even if they go back to 39.6 on ordinary income, doesn't have the 3.8%. So your capital gains, if you fit into that category of over $1 million, could wind up being at a higher rate than your general ordinary income. It could wind up at 43.4 plus your state over 50%, whereas your ordinary earned income would probably be at a lower rate because it wouldn't have the 3.8%.
Yes, great point, Larry. Thank you for that. So a couple of other things under Biden's proposals relate to tax credits. Under the current law, we have an earned income tax credit and child credits that fall under a certain amount, $2,000 per child and $500 for non-qualifying children, and those credits get phased out at certain income levels. Biden's proposal is a very generous one with regards to credits overall, with potential to increase dependent care credits, possibly expand the credit to childless workers who are 65 and over, increase the child credit to certain amounts for children within certain ranges there. And once again, for incomes between the 125 to 400 range, would receive a partial credit, and potential with that 400,000 magic number again, a phase out of those credits. Next slide, please. So itemized deduction, under current law, taxpayers can currently offset their income with certain itemized deductions, as we saw with TCJA, Tax Cut and Jobs Act. Some of those deductions, like state and local taxes or SALT, were capped at $10,000. So in theory, under the current law, charitable contributions, investment interest expense, mortgage interest, and up to $10,000 of state and local taxes are basically the itemized deductions that are currently out there. And to the extent there's ordinary income and such, 37%, those deductions would go against income at the ordinary rates at those percentages. With the Biden proposal, there is a potential for taxpayers, again, with incomes exceeding 400,000, there's that number again, to cap the overall value of that benefit of those deductions to 28%. So something to keep in mind there, certainly. And there, prior to Tax Cuts and Jobs Act, there was actually an overall limitation to itemized deductions that was referred to as the PEAS limitation. If taxpayers made over a certain amount, that with Tax Cuts and Jobs Act was eliminated. There is a proposal by Biden to restore that limitation for incomes over 400,000, and there's a possibility in some talks and discussions of that SALT or state and local tax cap to be eliminated. So in the education section and lending, as it relates to education, under current law, loan forgiveness is generally includable in one's income unless there's certain exceptions that apply, and student loan forgiveness would generally be included in income unless an individual worked for certain periods of time in certain professions. Under Biden's proposals, student loans would be canceled tax-free after borrowers have been enrolled in income-based repayment plans for 20 years. From a payroll tax, FICA, Social Security tax perspective, under current law, when incomes reach 137,700, the FICA tax for 12.4%, that is the cap for it. Under Biden's proposal, there's the potential to bring the FICA tax back once taxpayers' incomes have hit 400,000 or greater, and then there would be a holiday between the 137.7 and the 400,000. So that is definitely something to keep note of, to the extent some of these proposals do come into play in the next couple of years or so. Qualified business income deductions, or QBI, under the current law, taxpayers other than C Corps are generally allowed to deduct 20% of their QBI or qualified business income from a partnership, S Corp, or a sole proprietorship that they own. And that all depends on certain income, wage, and asset thresholds. This was done for individuals as it relates to Tax Cuts and Jobs Act to kind of put them in line, in theory, from a tax rate perspective with the corporate rate of 21%. It doesn't get them exactly there, but it was kind of the give and take, if you will, to get the individuals as close to that corporate rate from their pass-through income. Under the Biden proposals, for taxpayers, once again, exceeding that 400,000, there is the potential to eliminate that QBI deduction for taxpayers, and also to eliminate special qualifying rules for certain real estate investors, or real estate investors rather, I should say. Next slide, please. From a business tax perspective, under current law, very simple. We're a corporate tax rate of 21%. Under Biden's plan, there's potential to turn that rate to 28%. With the possibility of a 15% minimum tax on corps with book profits of 100 million or more. And that minimum tax would be structured as an alternative minimum tax, or an AMT, and corporations would pay the greater of their regular corporate tax or the 15% minimum tax, still allowing, of course, for net operating losses and foreign tax credits. And then also the possibility of a 10% offshoring penalty surtax on any profits from production by U.S. companies overseas for products that are brought back to American soil and sold thereafter. Credit incentives depreciation under current law, taxpayers can take a depreciation deduction of 100% of cost on eligible property, new and used property, known as bonus depreciation. That is expected, I believe, under TCJA to start to scale back starting in 2023. 80%, 60%, 40%, and 20% respectively for those 4 years of 23, 24, 25, and 26. Under the Biden proposal, there's no specific plans announced thus yet as it relates to depreciation deductions, so that's still yet to be determined. And there's also a proposed 10% Made in America tax credit for companies creating American worker jobs. So, and on the flip side, a 10% penalty on companies moving operations overseas. So something to certainly keep in mind as it relates to source of workers and employment on a go forward. Renewable energy credits, we'll touch on this rather briefly. Under current law, there's certain investment credits related to solar and wind energy primarily. Biden's plans to reinstate some credits that existed prior to TCJA, as well as some new credits. So a few credits out there, or potential credits, I should say, for renewable energy and things that would be more beneficial to the environment. from a real estate perspective, under the current law, taxes on gains of real property are deferred if the property exchange is that of like kind, and owners of certain residential rental property occupied by low-income tenants may claim a tax credit of a percentage of the qualified basis over 10 years. Under Biden's proposal, there is a potential goal to eliminate provisions favoring real estate investors within this real estate space. A lot of uncertainty as it relates to what exactly that means. If and when we ever get there and the law comes into play, we will certainly interpret it and discover planning opportunities as it surrounds that. But certainly something to consider within the real estate space.
Like-kind exchange was on the table for TCJA, but the real estate sector survived that. The rest of it didn't for like-kind.
Yeah, I think there's also talks in the in Biden's proposal as well with reinstating the first-time home buyer tax credit as well, and I think making an advance where you wouldn't have to wait to file your tax return as well. So something that's out there. And again, all of this is completely based on proposals and campaigning and such, and we don't know where things obviously would end up, but we would be remiss if we did not mention them and at least start thinking about them, both as tax professionals, as well as our clients and so on and so forth, and advisors to kind of start to, like I said, reverse plan, if you will, so that we're not kind of scrambling to catch up if and when this comes into play. Next slide, as it relates to GILTI and expatriation, GILTI standing for Global Intangible Low Taxed Income, and basically this is income that's earned by foreign affiliates of U.S. companies from certain intangible assets, such as patents, trademarks, and copyrights, just to name a few. And so there's currently a 10.5% on that type of income. And then there's also a special mark-to-market tax regime that may apply to U.S. citizens who renounce their citizenship. Under the Biden proposal, he plans to raise the minimum GILTI rate to 21% and to assess that GILTI on a country-by-country basis, with no specific plans announced regarding expatriation. So this chart outlines the various comparison of 2020 and 2021 amounts for payroll taxes. As you can see, the only real change is the wage base currently for Social Security, expected to increase in 2021 up to $142,800, which would be the max, and when it would stop, and all the rates would remain the same. Similar slide here as it relates to retirement contributions for 2020 and 2021 and the maximums that can be contributed to the various plans. As we could see, not too many increases, a couple of bucks as it relates to defined contribution plans and SEPs. So year-end reminders. This is a key one as we approach, the calendar flipping. We want to just keep in mind, taking a look at portfolios to see if there's any unrealized losses out there that we can realize against. If we're sitting unrealized gains, and we know that we're going to have large capital gain numbers for the year, if there's losses out there that we can shelter some of that with. If we like the positions, we're going to want to wait the 30 days to get back into them to avoid wash sale rules. Charitable contributions, that's a big one. We want to consider timing on that, depending on the tax rate we're in. If we're in an overall 20% tax bracket from a preferential capital gain treatment this year, we don't know where we're going to be from a tax rate perspective next year, or the year thereafter. We might want to bank some of those charitable contributions, just to kind of offset it at a higher tax rate. Reviewing basis in partnership and S corporations to determine if we need to make additional contributions to allow us to take some losses, prior to year end. Something definitely to keep in mind. Additional basis reporting is also required on the 2020 partnership K1. So it's something that we definitely want to be reviewing prior to year end to see from a basis perspective. And timing of income expenses, it's a big one. You know, we want to make sure that we're matching up similar to charity and capital losses and such. We want to make sure that we're matching up our expenses with, you know, ordinary expenses with ordinary income, or vice versa. So definitely something to keep in mind. Definitely conversations, you know, you should be having with your tax advisors as it relates to this, to ensure that we're doing the best we can to mitigate our tax liabilities. And last but not least, I wanted to touch briefly upon, also as a reminder, as it relates to year end, under the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act, that came about back in March. Prior to that, under TCJA, they had eliminated the carryback of net operating losses with an indefinite carry forward. And losses thereafter were then going to be limited to 80% of taxable income. Through 2020, and any NOLs generated can be carried back 5 years. So definitely something to consider and think about, and something that in conversations you definitely should be having with tax advisors if applicable. Certain situations it may make sense to carry back from a cash flow perspective, certain situations it may not, depending on a tax advantageous perspective. So again, all things we should be thinking about as we approach 12/31. I thank everyone again for your time, and I will pass it back on over to Kathy with our second poll question.
Yes, thank you, Craig. And before we get there, we do have a couple questions, Craig, if you could just let me read them to you. So first of all, the question is the state and local tax deductions that are limited to $10,000. Do you believe they're going to be fully deductible again?
Tough to say. I mean, it's something within the proposals that, you know, there's speak about eliminating the cap. Again, it's if they do become fully deductible, the talk with the limit to, you know, 28% overall of itemized deductions almost kind of puts you in the AMT range, so to speak. But, you know, there certainly would be the deduction for it. Part of the planning around that is what Shivani is going to be speaking about as it relates to the business entity tax or the BAIT tax. So great question. Wish I had a definitive answer for it, but certainly something that we're all going to be watching very closely.
Okay. Now, the other question is about this student loan forgiveness that we're talking about. Is that just for federal, or does that apply to the states also?
Meaning, would the states follow through that it would be exempt from income?
Yes.
Not certain on that. I mean, in theory, what I would guess is for the states that follow federal income, it probably would follow, but we've seen a lot of states decouple from various things with TCJA as well as the CARES Act. So again, tough to say, and be curious to see how it all plays out, but certainly a thing where if we do get there and it does come into play from a state perspective, certainly something to keep in mind as it relates to federal versus state planning.
Okay, and good. Someone asked the question, can you clarify what is a holiday?
Oh, sorry. So basically a holiday would be the period where that tax would not apply. So for that 137.7 through 400,000, during that period, that additional FICA tax would not be applicable.
Okay, great. We have a couple more questions that I'm going to leave till the next section. Let's go ahead and go to the polling question. Okay, what was not on the menu at the first Thanksgiving? Turkey, oysters, duck, lobster, or eel? Interesting selection. So we are looking to get a good number of registered voters before we close this out. Interesting. Okay, we're still going. If you're having trouble making the selection, please press escape, and that should help you make your selection. Little computer glitch there sometimes. Okay, so we've got 80% of you, and 80% of you said turkey. And the answer is turkey. You are correct. Congratulations. Okay, let's move on. And our next section on estate planning for year end, we have Joy that's going to present for us today. So Joy, we're going to turn it over to you.
Thank you, Kathy. I appreciate it. It's really nice to be here today. I'm new to SACS, but I'm excited to be working with my other professionals here, including Larry Gradsky, who will be offering some color commentary as we go through some estate planning that you absolutely at least must consider before the end of 2020.
You're putting the pressure on.
Well, that was my whole idea there. So right now, as Craig pointed out, we have a potentially divided government. That is, it looks like Biden will be the president. He is the president-elect and will be sworn in on January 20th. We have a Democrat majority in the House, and Senate is still up for grabs. So this does reduce the probability for a major change, but because of the massive federal bailouts that we've seen due to COVID-19, that may actually spark some resultant tax increases. I mean, the government is putting a lot of money out. There's a good likelihood that they're going to be looking for ways to bring some money back in. So on the horizon, we look to Biden's plan and try to discern from that what we could potentially be seeing. And one of the things that's probably scaring our clients the most is that Biden was talking about during the election a $3.5 million estate and GST exemption for taxpayers. By way of perspective, our current estate and generation skipping tax exemptions are at $11.58 million. So reducing it down to $3.5 million would mean that you have about $8 million less to give away to future generations of your family. That's a big reduction.
Or 16 for a married couple.
Correct, or 16. I can't do the math that quickly, Larry, so I appreciate the assist. So the other thing is that Biden was talking about capital gains on death. One of the biggest loopholes in the tax code is that on someone's death, all of the assets in their estate get an automatic step up in basis to the date of death value. Biden had talked about possibly getting rid of that step up on death. So that's something we want to be looking out for. One of the things that a Biden administration can do without buy-in from Congress is a return of the regulations that will restrict valuation discounts. So what even does that mean? Well, for assets that are really hard to value, interests in closely held businesses, for example, typically what we do is we go out and we hire valuation professionals like our friends here at SACS to look at the value of that business and then add in some discounts. If you were selling someone 50% of your house that you could sell for $1 million, well, the person wouldn't pay $500,000 for that 50% interest, because a 50% interest in a house is just not worth half of the total value, because you can't sell it and you can't control it. So our valuation professionals would be putting discounts on that interest. One of the things that IRS had been looking at before the Trump administration was imposing regulations that would restrict the ability to increase those discounts, thereby reducing the gift value of those assets. That can have a tremendous effect, particularly on our closely held business friends, because they're not going to be able to transfer as much of their business using smaller or lower gift tax dollars. And that is something that a Biden administration can do without any involvement from Congress, because you would only need Treasury to do it. Another thing that Biden had been talking about is a possible inclusion of grantor trust assets in the settler's estate. I think this is a really far off thing that we probably don't have to worry too much about it, but your planners should definitely have it in the back of their mind. I know we do here at Saks. Another thing that could be on the horizon is restrictions on generation skipping tax planning. That is making transfers to trusts that benefit future generations of your family, and then the potential increase in income taxes on dividends and capital gains, moving them from a preferential rate to ordinary income tax rates. Finally, and probably most importantly, those Tax Cuts and Jobs Act provisions that we've come to love so much over the last couple of years, those are all going to be sunsetting at the end of 2025 without congressional action. A democratically controlled House and a democratically controlled White House probably, is going to foreshadow the sunsetting of the TCJA at the end of 2025. So things to look out for. So things we want to make sure that you know before, and you do before the end of this year. First, you really want to be looking at those high lifetime exemptions and decide, do I really want to make a gift? And if I do, I should do it before the end of the year. As we said, each taxpayer has $11.58 million in gift tax dollars that they can give away before the end of the year. So that's over $22 or over $23 million per married couple. However, that's a big number. I have to recognize that, at least for most of the people that we work with. And that number is probably, hard to just give away. So it's really vital that you incorporate flexibility into any planning by ensuring continued access to those assets that you're transferring. So that's really an important key element to these discussions. Make sure that you're putting in some flexibility. Also, don't give assets away if you're going to need the income, unless we consider ways to allow you to get that income by looking at the cash flow and figuring out what's going to change once those assets are transferred. These are all the things that your planners should be thinking about and things that your Saks professionals are thinking about. Also, there's other reasons to make transfers besides just using up the lifetime exemptions. One of the most important reasons to transfer assets is to protect and preserve them, especially your closely held business interests. You may have already decided who's going to manage the business on your retirement and eventual passing, but maybe you haven't really figured out how you're going to get that ownership succession piece to be worked through. We can help you with that. And finally, I recognize that it is November 18th, so clock is ticking. We don't have a whole lot of time. We really want to be looking at those easy to implement strategies, the things that we can do right now without a whole lot of time left to do it.
Joy, just to interject before you move on, one of the hot topic that I've heard come up quite a bit, it's always an analysis when giving away large amounts, as we're suggesting now. If you haven't used your exemption and you're looking at it, let's say give away $10 million, depending on how much assets you have, that could be something difficult to do, worrying about cash flow. There are techniques, or there are vehicles where you can still have access to the cash flow through, for example, a borrowing from. If you transfer to a family partnership, there may be the opportunity to borrow back if necessary, or to a certain types of trust. There may be ways to borrow back. So the cash flow is always a concern, and we always watch for that. We don't want our client to be giving away and then struggling and stressing afterwards that they don't have enough to live on. But there are ways to structure to allow that flexibility, as Joy mentioned in her slide.
So let's talk about some of those easy to implement strategies. One of the things that we had done back pretty much in 2012, and then when we thought that the exemption was going to be, substantially reduced, is we convinced our clients to make transfers, big transfers to trusts, and then sell assets to them. Some of you may be sitting there with, with an income stream from a trust that purchased an asset from you. And if that happened sometime in 2012, I would imagine that the interest rate is somewhere in the neighborhood of 2.5% to 3%, depending on when you did it. And maybe it wasn't 2012, maybe it was some different year, but, those interest rates are, were higher than they are currently. The current long-term AFR rate for November of 2020 is 1.17%. So on $1 million, that's only $11,700 of interest that would need to be paid on any loan using that AFR rate per year. Not a very substantial number. I have to warn you, the December AFR rates just came out and they are starting to creep up. It's now going to be 1.31% effective December 1st. So if you wanted to invoke any of this strategy, I would recommend that you maybe put the turkey leg down before you start your Black Friday shopping. Give us a call. We'll try to, help you to refinance some of those loans so that you can lock in that 1.17% interest rate. I think Larry's working all weekend, so he'll be available to you for any of those questions. But one of the things we would look at, one of the things we would be looking at is that you could potentially substitute a new note with that lower interest rate of 1.17% for an older note with a higher interest rate to any trust or family member in order to reduce the interest payments. In order to make this work, make sure that the old note allows for prepayment. Most of them do, but you definitely need to make sure that that is in there, because otherwise you've got some kind of prepayment penalty. It might not be worth it. Also, make sure you issue a new note instrument. If there was any security on that original loan, you're gonna need to update those security agreements. And as always, consider disclosing this transaction on a timely filed gift tax return so there's no question later. The importance of timely filed gift tax returns, I'm going to keep coming back to this, is that it locks the IRS into a 3-year statute of limitations. They only get 3 years from the date that you adequately disclosed it to come back and challenge the transaction and try to recast it as a gift and not a loan. Excuse me. So here's a downstream planning opportunity with a long-term AFR rate of 1.17%. What if the parents already used up the $11.58 million each? So, we've already made gifts over $23 million at the parent level, and the children are sitting there and they don't really have the assets to be able to make transfers. What do? Well, in order to avoid losing the opportunity, perhaps this is a good time for the parent to make a loan to the child and then have the child make gifts that could then be using up said child's gift exemption. Some of the things I would want to make sure that you did, this is an aggressive strategy, so you've got to be a little careful here. Make sure you've got good advisors. Your SACS advisors are available to walk you through this and to work with your attorney on it. So here's some things that I would just want to, kind of point out. Make it look like a loan. It shouldn't be for an amount, it shouldn't be an exactly $11.58 million that you gift to your child and then your child the next day turns around and makes a gift. That just looks too much like you've made a deemed transfer to whomever your child is making those transfers to. There should be some time between the loan from the parent to the child and then the gift by the child. Perhaps the parent makes the gift before the end of November, so you can lock in that 1.17% long-term AFR rate, and then the child makes a gift sometime around Christmas. I like the idea of the child actually making a gift in a different amount than the loan. Maybe the parent lends $10 million and the child makes a gift of $11.5 million, so that the numbers are not exactly the same. Additionally, we should be possibly considering whether the child should make a gift to beneficiaries who would not ordinarily be objects of the parent's bounty. That is, people that the parent wouldn't otherwise have been making gifts to, like a spouse. So those are just some ideas that I just want to keep kind of in your mind. And a final word about intra-family loans. It's always a good idea to make the loan look like a loan. I don't think Bank of America would lend $10 million to any of us without requiring some kind of security, some kind of guarantee. A parent shouldn't do that with the child. An individual shouldn't do that with their trust. So it would be better to make sure that it looks like a real loan. Make sure that both the lender and the borrower are solvent. If the person lending the money then becomes a ward of the state as a result, or a ward of their family as a result of the transfer, that's probably not a legitimate loan. Always put things in writing. Make sure that you've memorialized the transfer, the transaction with a promissory note, a security agreement, a guarantee, those types of things, so that you can be sure that you are, you have backup and you have documentation memorializing the transaction. There should be economic consequences if payments aren't made. Usually what I see is like a 5% penalty for a late payment. So, those kinds of things I would expect to see in the note instruments. And finally, once again, make sure you're disclosing these transactions on timely filed gift tax returns. Let's not give the IRS anything. Make them take make them sit there with it on their desk for the next 3 years, contemplating whether they want to call us up and try to challenge those gifts. Please advance the slide. Another thing that the Democrats had been talking about during the election was eliminating or reducing the annual exclusions, which are currently $15,000 per donee. So currently, Larry can write a check to everybody on this call for $15,000, and he would not have a gift tax as a result of those transfers. However, that is one of those things that the Democrats are considering eliminating on a going forward basis. And the proposal would change this $15,000 per donee to $50,000 rather per donor. So instead of writing $15,000 to each one of you, Larry would only be able to write me a check for $50,000. And then he would not be able to make any additional gifts without using his lifetime exemption. I'll send you my address at the end of this meeting so you can make that payment, Larry.
Okay. I'll keep that in my file.
Now, we use these annual exclusions. You may have heard them spoken about differently by your SACS advisors. You may have heard them as crummy powers or withdrawal rights from your insurance trusts, because that's usually how we're using them. And basically, you have an annual premium of $90,000, and then you have enough beneficiaries so that you're not actually making a taxable gift, or you're using much less of your lifetime exemption because you have enough individuals who have the right to withdraw $15,000 each. Unfortunately, if the Democrats were to have their way and be able to change this to $50,000 per donor, in the scenario I just described, a $90,000 annual premium for a life insurance policy in a trust would result in a $40,000 taxable gift on an annual going forward basis. And that would reduce the lifetime exemption of the person making the transfer, unless they didn't have any, in which case that $40,000 would be subject to gift tax. So while our exemptions are still high, as I pointed out, it's $11.58 million per taxpayer, individuals may wish to consider making larger gifts to their insurance trusts than they otherwise would in a normal year before the end of this year. And the reason you would want to do that is because you want to put assets in that can then be used to self-fund those annual premium payments. You maybe want to consider putting in assets that generate an income so that the trust has income and then can use that income to pay the premiums. Maybe there's an opportunity here to talk to your insurance advisor and pay off those policies that are in the insurance trusts so that you don't have to worry about making that $15,000 per donee payment every year, particularly if that option goes away. Another opportunity that you may wish to consider if you're looking at other gifts anyway is to fund other trusts that have provisions that would allow those trusts to make distributions to the trust, to the insurance trust. So essentially, I have this dynasty trust sitting over here. It's got a bunch of assets. It has a bunch of income. And on an annual basis, the dynasty trust can transfer enough money to the insurance trust in order to pay the life insurance premium. In that way, you would be able to overcome any limitation on making those transfers to the trust in order to satisfy the annual premium payment obligation. And here it is, my favorite strategy of all for married people, the Spousal Lifetime Access Trust, or SLAT. This is a great strategy if you're married, and the reason is because you put assets into the trust, your spouse retains access to them. This allows you to preserve your exemption. You get to make a taxable gift, use up your exemption. If I have $10 million of exemption left and I transfer that $10 million to a trust for the benefit of my spouse, I have made a gift. I have wiped out my exemption. And then when Joe Biden goes and tries to change the exemption from $11.58 million sometime in January, February, March, whatever, retroactive to the first of the year, then in that case, it's not going to matter because I've already made that transfer.
Joy, just to elaborate on that, IRS kind of opined on this, I'm guessing it was a year plus ago, saying that if you have given away more than the exemption at the time, you've given away now your 11.5 million, and the exemption goes down, there won't be a clawback of that excess over the exemption. So, for example, if the exemption goes to 3.5 million next year, you've used your 11.5 now, and taxpayer passes away when the exemption is 3.5. Their exemption, and they give an 11.5, the exemption will be 11.5, not the 3.5 at the time. There's no clawback, or at least that's what the IRS is stating their position would be.
I think that everyone, you just witnessed the estate planner's version of the alley-oop, right? I set it up and Larry slammed it in. So that was awesome. Great. always fun to see that happen. So we transfer assets into a SLAT. We use up our exemption. As Larry pointed out, there shouldn't be a clawback. That's the expectation. That's what Treasury is saying now. I think it would be politically volatile for an administration to undo that guidance that we've all been relying on. So, and you don't want to make estate planners upset. I mean, we look like a mild-mannered group, but when our ire gets up, it can be bad. And then, of course, by transferring those assets to the trust, you get asset protection, but you retain access to it indirectly through your spouse. So long as you and your spouse are speaking, your spouse can go into the trust, take a distribution, and then share that distribution with you. So that's the concept, which of course brings me to the most romantic part of the Spousal Lifetime Access Trust, which is making sure that you at least consider putting in a floating spousal clause into the document. So what is that? That's not the, leave my spouse floating in the river. That is, I have a provision in my trust that says something along the lines of, whoever shall be married to the settlor, to me, at any particular point in time, shall be the individual who has access to the assets in this trust. So if my current spouse becomes my ex-spouse, but then I get a new spouse, said new spouse could then have access to the assets in the trust, and I would have access through that person. Very romantic concept. If you're creating two slats, lots of people like to do this. That's where I create a trust for my spouse creates a trust for me. You really want to make sure that they're different. They should be what's called non-reciprocal. This is where I must stress it's very, very important that you're working with competent counsel and that your tax advisors are present to work through any of these issues and make sure that we really are getting these trusts to be sufficiently different. Because the risk is if I set up a trust for Larry's benefit and I put $10 million into it, and the same day he sets up a trust for my benefit and puts $10 million into it, the IRS is going to say, no way. What really happened is Larry gave Joy $10 million and Joy gave Larry $10 million. So we're going to treat those trusts then, the assets in the trusts, as includable in each's estate. So the trust that I set up for Larry is not going to be, it's going to be disregarded. The one he set up for me is also going to be disregarded. All of the money that you spent on your advisors is going to be for naught. So let's not let that happen. Give us a call. We'll make sure that you're not in that boat, that these trusts are sufficiently different.
This is particularly important right now because we're really close to year end and something's going to be done. One of the items you see, as Joy has mentioned, is different timing. That's kind of hard right now. We're already in November. So you want to look for other, you can time a little bit differently, but not much right now if you're doing before year end. But there are other areas such as the provisions in the trust that can be different and different amounts that can help your cause for not having reciprocal trust.
Can you advance the slide? We really believe this is potentially the best time it will ever be for planning. We have historically low interest rates. They're 1.17% for those of you not taking notes. This is going to improve opportunities for intra-family lending, sales, and certain sophisticated wealth transfer techniques that are based on the AFR rate. We now have, and I know it's hard to look at your portfolios and see them kind of lower than what you would like to see them, but the market's going to come back. So we consider this to be an artificial depression of business valuations due to the market volatility that we're seeing. When these values bounce back, if you had already leveraged them out of your estate, you can give them away for smaller gift tax dollars than you will in a couple of years when everything bounces right back. The exemptions are very, very high, $11.58 million. It's never been this high. There is a political appetite on both sides of the aisle to bring that number down to something smaller. So, maybe it won't be the $3.5 million, which is on, some of the moderate Democrats' wish list. I wouldn't expect it to go down to $1 million, which is on the progressive Democrats' wish list. But an $11.58 million is probably not here to stay. I don't have a crystal ball. I don't think Larry does. Larry, do you have a crystal ball?
No, I had a client about a month ago who had a very compelling statement, said, this is going to be, this could be like post-World War II, with the government needing so much money. And if you look at the rates back then, it's scary because they were in the 90% range for income tax. So I think it's a pretty good bet that taxes they're not going down.
Yeah, I think that's fair. And another thing, and I didn't touch on this, is that it's an $11.58 million per taxpayer exemption with a 40% tax rate on assets over that number.
Biden and some of Biden's proposed, his ideas that had been tossed about over the last several months had that rate going up significantly.
Yeah, right. It had formerly been everything over the exemption went up to 55%. So, we can expect that tax rate to go up. Getting these assets out now, leveraging them out with the artificially depressed business valuations, moving assets out by using the low interest rates and any sophisticated wealth transfer techniques that, we can talk with you about. that's a good strategy, because you really don't want to be caught unawares when things do start to roll back. You really want to be planning to hedge against the risk that the federal government or the states might impose or increase estate taxes next year.
So Joy, I have, before we move on, just a couple of comments. One, and I don't know if you had mentioned it earlier, but if you did, I'll reemphasize. Yeah, we don't know that there'll be a change in the law come 2021, but with it, so if the Senate, is held by the Republicans and there's no formal tax law change, Biden still has an opportunity to work to eliminate, with Treasury, to eliminate things such as the valuation discounts, even without a change in the law. So we have to keep in mind that it's not and we've heard several times over the last few months, so let's see what happens with the elections, let's see what happens. Some of this may not, even if there isn't a law change, may be damaging if there isn't action taken now. Second is, we mentioned a few of the techniques, the slats and the loans. There's also others out there, such as transfers to a family partnership, where the availability of discounts on the transfer, and even if it is securities, there's some availability for discounts with marketability and minority interest.
Well, thank you, Larry.
Yep, go ahead.
I was just going to say thank you for your presentation and your thought-provoking ideas. We're always trying to stay ahead of the curve and make sure that we're implementing strategies that are going to keep more money in our pockets or our family pockets. So thank you. We have another polling question that we need to run right now. So Margaret, let's, good. Thanksgiving was proclaimed a national holiday by George Washington, Thomas Jefferson, James Madison, Abraham Lincoln, or Andrew Johnson. So if you can answer the polling questions, we'll look and see how we're doing. While we're going through this again, if you're having trouble, just press the escape button, and sometimes that'll allow you to answer the polling question if you're having trouble. And while we're waiting for this, I'm going to tee up our next panelist. We have Shivani Jain's going to talk about a new tax provision that we're all excited about. And we're almost finished with the polling. Okay. We're just at 80%, and the answer is The answer is Abraham Lincoln. So 24 of you got it right.
I was feeling bad. I didn't know the answer to this. I don't feel bad anymore.
Well, now you do. See, you'll win at Trivial Pursuit the next time.
Although I did guess Abraham Lincoln.
So let's move on, and Shivani's going to talk about the New Jersey bait. Interesting title. We didn't make it up. We're just delivering it. So Shivani, if you want to walk us through this.
Thank you, Kathy. Good morning, everybody. Hope all of you are staying safe. I'm actually missing our annual in-person update. I know Larry, Kathy, Stephen, and I really like the interaction we had in person, but hopefully we get there soon next year. I'm glad that you were able to meet the new addition to our Sachs family, Joy and Craig. We are really excited to have them. They bring a lot of experience, and our Sachs team is really, really excited to have them. So I'm going to start off by saying that a question was asked to Craig whether the SOL deduction limitation will stay. Based on the Joint Committee report, that deduction is worth, between the years 2018 to 2027, it's worth $600 billion. So before I think the lawmakers think about eliminating the limitation, they probably have to make up this revenue elsewhere. So I'm not sure if that's going to happen, in the near future, but there is talk about increasing the limitation, maybe from $10,000 to $20,000. So because of this deduction limitation being placed to $10,000, a lot of states, especially the high-paying jurisdictions like New Jersey, New York, California, were thinking about workarounds on how they can actually give something back to their residents in way of these tax deductions. So states like Connecticut, New Jersey, Wisconsin, and Maryland have actually enacted entity level tax as a workaround. So what that means is actually the entity pays the tax. What's flowed through from your K1 is actually reduced by the tax you pay. So in effect, you're picking up less federal income, thereby giving you a deduction indirectly. So New Jersey enacted the BAIT tax in January of 2020, and they came up with more FAQs around October 8th of 2020. So I'm just going to go over some basics based on the FAQs and what we know as of now. We still have some questions, which we are debating over on how New Jersey is going to handle that. And as and when we get the clarification, we will send out more email blasts and FAQs to you. So as I said that this tax was effective January 1, 2020. It is an elective tax. So you have to make an annual election year by year. This election needs to should be made electronically on or before the due date of the return, which is currently March 15th. If you decide for some reason, that you made the election and you now want to revoke it, you also have to do it electronically on or before the original due date of the return, which is March 15th. So if you paid in any estimates, then there is a refund form which is not available right now, and you have to file the refund form to get the taxes paid back. So there are different type of entities that are eligible for this BAIT tax. Partnerships, it's a flow-through entity, your S corporations and your LLCs. Single member LLCs and sole proprietors cannot elect to pay BAIT tax, because this, for single member LLCs and sole proprietors, you're basically paying the tax on your 1040, either on a Schedule C or a Schedule E maybe. So you won't be able to get this deduction at the entity level. So how are you going to, go about the compliance for the BAIT tax? Form PTE 100 needs to be filed by March 15th. There is a 6-month extension which you can get by filing Form PTE 200T. New Jersey also requires you to make quarterly estimates, April 15th, June 15th, September 15th, and January 15th. Because this is the first year of this tax being implemented, New Jersey has given everybody a 1-year pass. They are not going to put any underpayment penalty for not paying the estimates for 2020. That being said, if you are a cash basis taxpayer, we would recommend that you pay the tax by December 31st, 2020, so that you get a deduction in 2020 on your federal tax return for it. A lot of questions were asked to us in the past that, what if I had overpayment on my New Jersey 1040? What if I have non-resident withholding? Can they be transferred to the BAIT tax regime? New Jersey has come out with FAQs clearly stating that, taxes paid in other kind of format will not be able to be transferred towards the New Jersey BAIT tax. So if you are overpaid on your 1040 or if you have any other tax being paid, you probably have to file your personal income tax return and then get a refund of those taxes. So just to go over the tax table, what tax rates you would be paying taxes at. For the first $250,000, your tax rate would be 5.675%. Anywhere between $250,000 to $1 million, you would pay 6.52. $1 million to $5 million, 9.12, and over $5 million, you would pay 10.9. I'm going to go over two examples for it. So let's take an example number 1, where your entity is 100% New Jersey based entity. It makes $1.5 million, and there are 2 shareholders or 2 members, member A and member B, who own 50-50. It's a New Jersey entity. New Jersey apportionment is 100%. So your allocated income is around $1.5 million. A and B each get $750,000. So based on the tax tables, which we discussed in the previous slide, the total tax due would be around $108,000, and both A and B would get their share of $54,000 each. They would get a K1. It's called the PTE K1, whereby their allocated income of $750,000 and this BAIT tax paid of $54,000 would be reported. Next slide, please. So in this example, what if you have other states where you're doing business in, and New Jersey source income is only 60%. So in that case, we are taking the same partnership. It was $1.5 million of revenue of income. The New Jersey apportionment was 60%. Your allocated income in that case would be $900,000. A and B would get $450,000 each. The tax due would be 56, and each of them would get a credit of paid tax paid of 28,000. Few other questions that we have been asked is, okay, if I'm paying the paid tax, do I really need to pay estimated tax payments? So there could be like different scenarios, right? If you have other income from other sources, you probably would still need to make estimated tax payments. Or in this case, where your income from New Jersey source was 60%, and let's say if the remaining 40% came from Florida, right, where Florida doesn't have any income tax, you would not get credit for taxes paid to other jurisdictions. So you would have to pay some sort of estimated tax for the difference of 40% that could be essentially coming through under 1040. So related to this tax enactment, I think the first big question was, is IRS going to bless this, workaround? Recently, on November 9th, IRS actually came out with Notice 2020-75, and they said that they were planning to issue proposed regulation. And they clearly said that, entity level tax imposed on pass-through were not subject to the $10,000 SALT limitation. So they are, in effect, blessing this kind of workaround. So that's great news for taxpayers. The next question was also, Connecticut has passed through entity level tax. New Jersey has passed through entity level tax. So if I'm a New York resident, would New York give me credit for these entity level tax paid on my individual return? So I believe New York has not come out and said anything directly, but I think based on the commentary we have read, New York would probably honor this kind of credit as well. The last thing which I would probably want to wrap up with is, if you have tiered partnerships and you're withholding tax at the lower tier, you could claim this credit at the top tier also by filing Form NJCBT 1065. So that was a quick rundown of the New Jersey bait tax. If there are any questions, I'm happy to answer them.
Thank you, Shivani. And before we go on to our next polling question, I do have one question in the queue that I've been holding up for this section. And because the bait tax is not eligible for single member LLCs, are you recommending that people make S Corp elections in 2021 for this or any other tax planning ideas?
Yeah, I think if you're a single member LLC, if you can add another member and, make it a two-member partnership or an entity or make an S Corp election, yes, you would definitely get benefit of this deduction. So we should definitely think about it and talk about it with your advisor here.
But is there any benefit of being an S Corp versus an LLC in other areas of the tax planning that we should be considering?
I think probably self-employment tax comes to mind. That's the biggest one.
Okay. So is it fact-based or is it something that's clean cut? Everybody forming an entity from now on should be an S Corp or an LLC?
I think it's facts-based. I wouldn't say it's clean cut that, you would either make an S Corp or a partnership. You need to have discussions on your particular scenario and what your ultimate intent is in the next couple of years.
Kathy, I think in any case where you're considering change, you need to look at all the factors, and there's no one cookie cutter answer to that question. Sometimes it's going to make sense. Sometimes there's other issues that come into play that can counteract the benefits. So you need to look at every situation separately.
Yeah.
Okay. And Larry, while you're with us, just to follow up on some of our planning and just to get back to some of the gifting you were talking about, is there any negative reason or detriment to gifting now versus waiting?
Well, the only traditional real traditional downside to gifting has always been loss of step up in basis. So for example, if you have an asset that has a basis of $1 million and is worth $10 million today, to make it simple, and you gift that asset away, you're using your $10 million, your exemption, but the recipient, the beneficiary, only keeps your basis of $1 million. If you had taken the same situation and you kept that asset in your name and died with it in your estate, there would, under current law, there would be a step up to, and so that your beneficiary would receive a basis of 10 million, assuming there's not a change in 2021 or afterwards. But having said that, if you think about it, if you're transferring marketable securities today that have appreciated, let's say into whether it's into a SLAP or into a family partnership, or you're doing your year-end planning now to use your exemption, and you have marketable securities that have appreciated, what's the chance that those securities would have been held by you through, for many years through your death? So if they're going to be sold anyway during your lifetime, you haven't lost that step up. It's not, the step up is needs to be taken into consideration more. I think it more applies in situations where you have an asset that's long-term, for example, a building or a partnership that owns real estate that has low basis in it, but high value. You need to consider whether or not it makes sense to gift that away, lose the step up, as opposed to holding on to that and choosing a different asset. Quite often we look for assets to gift away that have higher basis and higher potential for appreciation going forward.
Good, thank you. And before we go to the next session on the PPP loans, I want to just follow up on one other internal question, and that was, will the rules for depreciation change in 2021, or you think they're going to be the same as 2020? Does somebody field that question?
So I believe the depreciation rules for 2021 should be staying the same under Tax Cuts and Jobs. In 2023, it'll start to scale down to, I believe, 80%. So assuming no changes are enacted, that should remain.
Okay, great, because that's one of our year-end tax planning tools that we use on a regular basis. Just want to see the security of that. So we're going to do our next polling question, and then we're going to move on to Stephen with the PPP. So which character has made the most appearances in the Macy's Day Thanksgiving Day Parade? Kermit the Frog, Bullwinkle, Mickey Mouse, Smokey the Bear, or Snoopy? Wow, it looks like everybody's all over this one. We're just going to wait a couple more seconds to get the vote count up, and then we're going to present the results. But it looks like most of you knew this. Okay, just a second more. Okay, we're good. So let's show the results. Snoopy is the answer. And everybody out there knew that. That's great. So we're going to move on to the next session with Stephen Ehrenberg, who's going to talk about the PPP update, what's new, and when to apply for forgiveness, which we know that a lot of people are working with. So we wanted to give you an update on the status of the program at this time. I'll turn it over to Stephen.
Thank you, Kathy. I hope everyone is doing well out there today. So before we get into what's new from the PPP standpoint, we're just going to talk about some of the various loan options that are available. The PPP, or Paycheck Protection Program, we're all familiar with. It's potentially forgivable loans if the money is spent correctly within the covered period and then the application is approved. And we've seen that there is some new items related to forgiveness. And as it says below, 2 million loans over 2 million will automatically be audited by the SBA, but that doesn't mean that loans below that just get a free pass. It is possible that the SBA performs a spot check. So you definitely want to have documentation in order. There's also 2 traditional loan programs out there, one of them administered by the SBA and one of them administered through financial institutions but backed by the Federal Reserve. The first being the Economic Injury Disaster or EIDL loans, a traditional loan program that now is limited to $150,000 with a 30-year term. Interest rates range from 2.75 to 3.75%, depending upon if you're a non-for-profit or for-profit business. The program, the EIDL program, runs to the end of this year, and you can do your application through the SBA, but funds are dwindling, so you'll want to get your application in. The other program, the Main Street Lending Program, there are 3 loan options available for for-profit businesses. There's also available options for nonprofits as well, and it really depends on a minimum and maximum loan amount, which is EBITDA and EBITDA based along with your current and unused debt. And this is, as it says, applied through your bank. So if you check the Federal Reserve Bank of Boston's website, there is a map there that will tell you what loaning institutions are participating in your area. And I know it says there's 3 loan options available here. There's actually another set of loan options available for nonprofits as well. So if they're nonprofits that are listening, there is options for you as well. So on the next slide, we just have a couple statistics related to the Main Street Lending Program. And just want to point out here that the Main Street Lending Program was a $600 billion program, but only $3.7 billion in loans have been administered to date. So there is room under that program, and the Federal Reserve acknowledged that and reduced the minimum loan and also adjusted the fees so lenders would be encouraged to give out smaller loans. So if you're looking for a more traditional loan facility, you've exhausted your PPP funds, the EIDL and the Main Street program are available. So now let's move on to 2 items that have received particular news in the press lately, if you will. The first being the loan necessity questionnaire. It's not in its final format. There is a comment period through November 25th, so another week, the purpose of which, when it is in its final format, is to gather support behind the good faith certification that borrowers made when they initially applied for the loans, basically saying that the economic conditions made the loan necessary. And as we see, and this applies to loans only in or 2 million or more in the aggregate. Next slide, please. So it's for borrowers with loans in excess of 2 million in the aggregate. So your affiliates will be included in that as well. And the way it will work, as at least in its current standpoint or current state, is that when the borrower submits for forgiveness to the lender approves, hopefully, the forgiveness application, submits the forgiveness to the SBA, at which point the SBA will contact the lender and ask the borrowers to complete this form. And again, we'll see after the comment period if it is revised. In its current state, both for-profit and nonprofit entities are required to give both a business activity and liquidity assessment. They essentially are going to look at your revenue, comparing it to periods, how you were shut down, and what's your cash position before and after the period. So if you go to the next slide, you see what the requirements are for nonprofit entities as well. They're fairly similar, just in terms of what kind of information is needed. And again, I stress the fact that the form is not in its final format, but if it stands, borrowers will receive 10 business days to complete the form. So I do suggest that you get your information at least ready in the current format as it's in. Take a look at the form, and then let's see where it stands. So that's something that is a big item, and hopefully we receive after the comment period closes next week. Hopefully we get some news after Thanksgiving, and we can see what direction we want to move in here. So in addition to the loan necessity questionnaire, back in October, the SBA issued guidance surrounding borrowers that may have a change in control. This is for lenders, but obviously if the lenders have to go through certain procedures, then it's going to impact you as borrowers as well. So a change in control, we see what the definitions are here, a change in at least 20% of your common stock. When I say common stock, I'm also referring to partnership units, so it's just really an equity transaction. you sell at least 50% of the fair market value of your assets, or the borrowers merge into an entity. So moving on to the next slide. If your PPP note is paid off, satisfied, or loan forgiveness process is completed prior to the closing, then you're done. The lender and the SBA will have no restrictions because you've already gone through the process. You don't have a note, or you've received forgiveness. But this means the process is completed. It doesn't mean that you filed your forgiveness application, you haven't heard back yet. So in situations where the note is not satisfied, we see here what type of items the lender can approve without SBA approval. Essentially a 50% or less equity transfer, or a sale or other transfer of more than 50% of your equity or 50% or more of your assets, provided that the borrower A, submits a loan forgiveness application, and B, funds an interest-bearing escrow account. So those are two items you're going to need to consider if you're going through this. And as Joy and Larry were talking about, gifting does fall into the realm of transfers. So if you're going to be transferring equity interest or assets of a business, this is something you need to consider. Next slide, please. All the other transactions that don't meet that, essentially, if you're not going to fund your escrow and apply for forgiveness, then the lender cannot unilaterally approve this. They need the SBA to approve it as well. And we see here that the lender must submit a request to the SBA to essentially say, well, here's why the borrower doesn't want to do this. Why can't you satisfy the note? Tell me about the transaction, a listing of the owners and whatnot. And you see that the SBA could require additional information. And then the SBA has another 60 days to review your request. So can you imagine being at the table, getting your loan or getting your deal about to be signed, and you say, oops, we forgot to consider this. It could potentially create a deal, and the results could be devastating. Next slide. So these are just some other additional things you need to consider if you're, for instance, selling greater than 50% of the fair market value of assets or transferring them, and in essence, SBA approval is required, meaning you didn't fund the escrow. The buyer will assume the PPP obligations, and you're going to need to include some sort of language in your purchase agreement. The information here pertains to all stock and equity transactions as well, essentially saying that the borrower or the merger, the successor to the PPP borrower, remains subject to all the obligations, and the SBA will have recourse against the former owners. So again, just items to consider. And then if you move on to the next slide, in a condition where the new owner or the successor entity has an existing PPP loan, essentially you're going to have to segregate and keep these items separate and provide documentation indicating that you've met the requirements on a per borrower basis. So it's really important if you're considering a transaction, and we see here what happens when a merger occurs as well, that you're essentially going to have to include and provide documentation as to how you met the needs for both loans. So something for people under or considering a change of control. This guidance was effective on or for transactions entered on or after 10/2, so we're certainly in that period. Now we move on to the next slide, and I know this is a question that's come up a lot in terms of when do you apply. There's a number of reasons to consider or not to consider. The one that's received a lot of press, if you will, at least on the tax side, is will the expenses be deductible for tax purposes? And we're anticipating guidance from Treasury when overlapping years are come into play. And those situations would be where a borrower receives the PPP loan in 2020, but does not receive forgiveness until 2021. Our position had been, and there is contradicting positions out there, that it was still a loan as of the end of the year. So therefore you would deduct the expenses in 2020. And then once you did receive forgiveness, you'd have an income pickup or an expense reduction in 2021. Well, our understanding, and nothing has come out yet, is that Treasury is going to release guidance indicating that if you have a reasonable expectation of loan forgiveness, that you would not deduct those expenses in 2020. Now, what does reasonable mean, and when is that determined? We don't know yet. This guidance, again, hasn't even been released yet, but this is certainly something to consider, especially for borrowers who have loans over $2 million and are going through the potential loan necessity questionnaire. But there are other implications here as well, financial statements. Did you have a change of control, which would essentially require you to submit that? So suggest to work with your advisor. There really is no black and white answer. Every situation is going to be different. So, take a look here. We're going to email out the slides. And if you have any questions, certainly reach out. But this is something you're going to want to consider as you are putting your loan forgiveness applications through. Okay. So the next slide, what we have here is just a loan forgiveness form decision tree. So if you are considering which form to use, there are three: the 3508S for borrowers with 50,000 or less in PPP loans, the EZ, which we hope a number of borrowers can fall into because the documentation requirements are less, and lastly, the long form, or the form 3508. So again, something you're going to want to consider as you start going through the loan forgiveness process. And we, as your SACS advisors, are here to answer any questions should they arise. And with that, I'm going to turn it back over to Kathy.
Thank you, Stephen. I really appreciate that update. And thank you all the panelists for sharing your expertise with us today. I just want to clarify that once you download your evaluation form to obtain CPE credit, can you please mail the form to jtosi, J-T-O-S-I, at sacsllp.com. It is not on the form, but it will be on the last page of the PowerPoint presentation when it is emailed to you. So you'll have it.
I'm sorry, Kathy, I'm sorry. Can I make one more point? I'm sorry, it's something that's important.
Absolutely.
In terms of the PPP expenses, there also is bipartisan support out there to make the expenses deductible. So there is a bill in front of Senate which could essentially make this whole thing moot. I definitely should have mentioned that. As of now, they are not deductible, which is why in overlapping years, you deduct them in one year and pick them up potentially in income. But I should have mentioned that there is bipartisan support to make these expenses deductible, which would add stimulus and make a lot of this moot. So there are a lot of moving parts out there, and I apologize for interrupting, but I wanted to make that point.
Well, thank you, Stephen. And that just goes to show how uncertain some of the positions are. And you should watch for emails from us, because we will send out literature on the topics as they are decided or as we get further clarification. As always, if you are not registered to receive our emails, please email me or anybody on the team, and we'll make sure you're added to the list. And so that ends our program for today. I want to thank you for joining us, and from all of us at SACS, we wish you a happy Thanksgiving and hope that you can join us for our next CFO series webinar. Have a great day.